Stop everything. Close your trading apps. Step back from your portfolio. What happened in the last 24 hours is one of the most violent single-day repricing events industrial commodities have ever seen. And it wasn't triggered by war, not China, not the Fed. It was triggered by 8 words on a Microsoft earnings call. Words that erased $400 billion in market cap in a single session and sparked a 14 silver dump, wiping out 2 weeks of gains in under an hour, January 29th, 2026. Microsoft reported earnings. CEO Satya Nadella and CFO Amy Hood revealed they spent $37.5 billion in a single quarter building AI data centers, and they still can keep up. Not because demand is endless, but because they physically can't build fast enough. Wall Street realized the AI revolution is burning cash faster than it produces profits. And silver, the metal at the heart of every AI server, GPU, and data center cooling system, was slammed in a liquidation cascade that blindsided almost everyone. Yesterday was the day the market stopped believing in the AI narrative and started demanding proof. And when narratives snap, fortunes get destroyed. Here's the timeline. On January 28th, after the market closed, Microsoft reported Q2 earnings. Revenue $81.03, EPS $4.14, both beating consensus. The stock should have popped. Instead, it cratered, down 12%, roughly $400 billion gone in one session. That's Microsoft's worst single-day loss since March 2020. And the trigger wasn't T-bad earnings, it was spending. $37.5 billion in CapEx in one quarter, a 66% year-over-year jump on AI factories, data centers, NVIDIA GPUs, power infrastructure, and cooling systems. Azure grew 39%. Sounds amazing until you realize growth was capped not by demand, but supply. Microsoft can't build data centers fast enough to fulfill $80 billion in existing Azure contracts. That's $80 billion in promised revenue they physically can't deliver yet. Investors ask the obvious. If you are spending $148 billion a year on AI infrastructure and still can keep up, when does it turn profitable? And that's when silver collapsed. Silver isn't just a precious metal. It's the industrial backbone of AI infrastructure. Every server, every GPU, every cooling system uses silver solder, silver paste, and silver-coated heat exchangers. When Microsoft admitted the AI build-out is hitting physical limits, the market instantly repriced expected industrial silver demand. The result was savage. Silver had been ripping $103 on January 23rd, $111 by January 27th, and a fresh all-time high of $121.64 on the morning of January 29th. One of the strongest modern rallies ever, up 64% year to date. Then Microsoft reported, within an hour, silver dropped to $107, a $14 wipeout in roughly 60 minutes. Roughly 1.1 billion ounces of paper silver liquidated, margin calls fired. Algorithms dumped into a vacuum. By the close, silver was around $128.84, down 6.6% on the day. What caused the cascade? Leverage. Silver futures are heavily leveraged. Small moves create massive P&L shocks. When silver slid from $121 to $118, margin calls triggered, brokers liquidated, and selling rolled across New York, London, and Asia. By New York close, spot silver was $108 or $84. The paper-to-physical spread blew out. Shanghai's premium widened from $8 to $15 per ounce, with physical silver in China trading near $120, while New York paper hovered around $108.8. That ASA dislocation screaming forced liquidation. Was this panic a one-day event or the start of a deeper correction? Look at what didn't change. Fundamentals remain extremely bullish. China's export controls are still in place, COMEX inventories are declining, and industrial demand from solar, EVs, and 5G is growing. What changed was sentiment, and sentiment is temporary. Fundamentals are permanent. The psychological trap is clear. Watching silver drop $14 in 3 hours triggers the urge to sell. But the best time to buy silver is often when it's crashing, not when it's trending and everyone is celebrating. The loudest panic is usually the best entry. Why did Microsoft's earnings trigger the silver dump? Silver demand in AI data centers is real, but largely one time. Each data center can use around 15,000 ounces of silver, roughly $1 million at current prices. Once installed, that silver is locked in. The immediate demand depends on new builds. If Microsoft hits bottlenecks and can't build fast enough, fewer new data centers mean less silver consumption in the short term. And that's exactly what markets priced in on January 29th. But remember, Microsoft isn't the only player. Google, Amazon, Meta, and Oracle are all building massive AI infrastructures. Physical silver demand may slow briefly, but it's far from gone. This wasn't just a silver story. It was a stark reminder that the market's narratives can snap overnight, fortunes can be wiped in minutes, and industrial metals are directly tied to the physical constraints of technology. And then there are private players and neoclouds scaling fast. So even if Microsoft slows temporarily, global data center construction can still accelerate, meaning silver demand can keep growing. Microsoft's problem isn't lack of demand, it's physical limits. GPU supply, power grid approvals, water access, construction timelines. Those constraints get solved over time. NVIDIA ramps, utilities expand, cooling tech improves. When bottlenecks clear, build-outs accelerate again, and silver demand can spike with it. So the January 29th sell-off wasn't about fundamentals collapsing. It was sentiment, fear, a narrative wobble. Traders asked, what if AI demand slows? The answer, it doesn't end. It pauses, consolidates, and continues. AI isn't a fad. It's infrastructure. And infrastructure build-outs don't die from one ugly earnings reaction. They slow, then resume, and silver tends to follow. But Microsoft wasn't the only catalyst. And that same day, Oracle reported earnings, dropping 5.4%. Why? Oracle admitted its data center pipeline was delayed, with power availability as the main constraint. Wall Street heard constraint and sold. Oracle is a major AI infrastructure play, partnerships with NVIDIA, government cloud deals, AI workload services. If Oracle is bottlenecked, the AI data center narrative looks shaky, at least short term. That contributed to a broader tech sell-off. NASDAQ dropped hard. AI infrastructure stocks were hammered. NVIDIA fell 2.7%. Options markets went wild. Puts spiked. Traders bet on deeper downside. But here's what most people ignore. Even with all the fear, global data center construction isn't dying. It's accelerating. Projections show capacity growth rising sharply into 2026. The AI infrastructure is slowing. Narrative is often factually wrong in aggregate. Certain companies may slow temporarily, but the industry overall can still boom. And if the industry booms, silver demand grows. So why did the market dump? Because markets trade narratives first, data later. When the narrative breaks, even temporarily, prices crash. Then value buyers step in. That's exactly what we're seeing now. Now, let's talk about the elephant in the room, China. While Microsoft and Oracle were highlighting bottlenecks, China tightened its grip on silver supply, creating a paradox. On one side, AI data center demand can plateau in the US short term due to construction bottlenecks. On the other, China's export controls create a physical supply crunch. Here's what happened. On January 1st, 2026, China implemented new export controls on silver. They reclassified it as a strategic material under a dual-use export list, limiting exports through licensed firms. That's seismic because China refines a massive share of the world's silver. When they tighten the door, global supply gets squeezed. Shanghai premiums widened massively. By January 29th, after the crash, the spread blew out toward 15 euros. Chinese buyers paying around $123 while New York paper traded near $108. That's not a small arbitrage. That's a broken market. Physical supply being locked while paper markets are forced to sell. And these export controls aren't temporary, they're structural. China prioritizes silver for solar, EVs, and strategic electronics. That means ex-China supply stays tighter, putting a long-term floor under prices. Even if US demand pauses, Chinese demand can absorb supply, and premiums eventually drag global prices upward. Now, COMEX. While everyone focused on Microsoft and Oracle, COMEX registered silver inventories dropped again, around 129 million ounces on January 27th, down to 127 million by January 29th. That's a 2 million ounce drop in just 2 days, coinciding with a $14 price crash. Normally, when prices collapse, physical supply increases as people dump. Not here. Someone was taking delivery during panic. Likely industrial users, sovereign players, or big money converting paper claims into physical. They accumulate quietly while everyone else panics. This matters because if COMEX inventories keep declining, the exchange becomes vulnerable. Futures contracts are promises to deliver physical metal. When deliverable metal tightens, credibility is tested. If credibility breaks, demand shifts hard toward physical, and physical supply is limited. That's when squeezes go violent. Inventories have been falling for over a year, from 180 million ounces in January 2025 to 127 million in January 2026, roughly a 29% decline. If this pace continues, the exchange looks increasingly stressed. So while the market panicked over Microsoft and Oracle, the smart money is watching inventories. They don't lie. Physical silver is disappearing, and when it's gone, paper price becomes less relevant because you can't deliver what you don't have. What happens next? This is where fortunes get made, or lost. You either panic, sell the bottom, or stay calm and buy the dip. Here's what we know. Microsoft and Oracle's infrastructure constraints are real but temporary. Grids get upgraded, GPU supply increases, timelines improve, build-outs accelerate again, and silver demand surges. China's export controls are structural. Silver stays in China, keeping global ex-China supply tighter. COMEX inventories are declining. Industrial demand continues to grow. The January 29th crash? Sentiment, not fundamentals. Fundamentals don't change overnight. If you held through it, you stayed calm while everyone else panicked. Now you're positioned for recovery. Silver can bounce violently. $5 moves in a day, $10 in a week. If inventory stress escalates, upside can get explosive. If you're on the sidelines, this is chaos that creates entries. 1.8 or $110 is cheap. Anything under $115 is a gift. 6 months from now, if silver hits $150, you'll realize this was your opportunity. To be fair, smart contrarian voices exist. Somewhere in silver looks bubbly. Marko Kolanovic compared recent moves to historical blow-off rallies. Peter Brandt flagged parabolic flows and setups for deeper pullbacks. They might be right. Short-term silver could dip further, $100, $95, even $90 if panic intensifies. But here's the difference in 2026. This rally isn't just leverage gains. It's physical supply stress, export controls, inventory declines, and real industrial demand. Structural forces. They don't vanish from one ugly day. Short-term corrections can happen, but selling here is how people get shaken out before the rebound. January 29th, 2026, Microsoft erased $400 billion, Oracle fell 5.4%. Nvidia dropped 2.7%. Silver collapsed from $121 to $101 in 3 hours. One of the nastiest one-day repricings for AI infrastructure stocks and industrial silver. Wall Street missed the key point. Physical constraints are not demand destruction, they're temporary bottlenecks. When cleared, build-outs and silver demand surge again. China's controls are structural. COMEX inventories are declining. Industrial demand is still growing. The paper market just experienced a historic forced liquidation, tightening physical supply further. Here's the call. Silver likely bottoms between $105 and $110, consolidates for a few weeks, then pushes toward $150 by March. If COMEX inventories crack and paper credibility is questioned, $200 by June is possible. Not hype, it's physical supply tightening while demand refuses to vanish. Holding silver? Don't panic, sell the flush, let weak hands liquidate, let leverage get rinsed, then ride the recovery. Sold during the crash? Buy back in. Own the mistake and re-enter before momentum returns. Watching silver run from $108 to $150 while sitting in cash is how wealth gets left behind. Not in silver yet? $100 is a gift, a once-in-a-year entry created by panic, not fundamentals. Wait too long for the perfect dip, and you'll watch the rally without you. January 29th proved it. Microsoft blinked. AI build-out hit limits. Markets reacted violently, but the fundamentals didn't change. Physical silver remains tight. The opportunity is now.